morning, everybody, and it's great to be here. So about a year ago, we were here in New York, and we presented our turnaround plan, and we laid out the 2018 and 2020 objectives. And shortly after that, we presented our 2016 guidance, and we described the key actions that would turn this business around. A three-phase plan. We were de-risking the business, rebuilding earnings and cash flow, and deleveraging the balance sheet in the longer term. Today, a year later, I'm glad to be able to say that we're executing on that plan, and that we're on track to meet all of our objectives as we stated them last year. 2016 has been a year of important milestones. We've accomplished a lot, we've improved performance, and we de-risked the business. We've also set a strong foundation for 2017 earnings and cash flow acceleration, and we're going to talk to you a little bit about that today. Our 2016 accomplishments have established liquidity strength that clears a runway for value creation as we improve the business and as our new products drive top-line growth. Today, I think we have a lot of very powerful momentum in the business. So maybe turn it over and look at 2016 first. There's nothing new in the numbers I'm showing you here this morning. It's essentially the guidance we provided in our Q3 call in November. What's important is to take a step back and just observe a little bit of the progress we've made. If you start on the left side of the chart, you'll see that EBIT will come in between $350 and $400 million, and that's at the top end of our guidance range. If you remember when we set this guidance early in the year in 2016, it was $200 to $400 million, and at that time, we still had to certify the CS 300. We were in the midst of ramping up production and preparing for entry into service. Our Global 7000 was still in the pre-test phase, and we were still adjusting our business jet franchise to lower production levels. Our results demonstrate strong execution, and they delivered the early benefits of our transformation during what we characterize as a transition year. We also, in 2016, experienced free cash flow improvement of about $500 million versus 2015. And we continue to progress towards our 2018 free cash flow break-even objective. Our business unit margins are expanding across the board versus last year. With the exception of commercial aircraft, the BU margins are all above 6%, and the average ROS growth improvement has been 100 to 200 basis points in every segment. In transportation, we've grown 100 basis points, and we've done this while we managed working capital very tightly, generating free cash flow. We've grown 150 basis points in business aircraft, and we did this on a revenue reset that we had planned earlier in 2015. I think what's interesting to note here is that on $1.5 billion of less revenue in business aircraft, we will deliver more EBIT in 2016 than we did in 2015. We've grown our aerostructures and engineering margins by 200 basis points, and we've done this while we've ramped up the C-Series wing and cockpit production, and this is coming from the efforts that Jean is having on his organization in taking out cost. Let's talk about commercial aircraft. Their EBIT will come in $100 million better than our original guidance of a $550 million loss. And the improved expectations are simply a product of hitting all of our program milestones and great aircraft performance in the field. 2016 performance is evidence that we're transforming the company so it can perform in any market environment. So, as we enter 2017, the second year of our 5-year plan, we're coming in with lots of confidence. We've launched the initiatives, and we've taken the proactive actions that are necessary to support our target performance, and we're confident in our ability to execute. In 2017, we'll resume growth after resetting activity levels in both planes and trains in 2016. We're essentially maintaining current production rates into the first half of 2017, and then we'll grow prudently in the second half as we prepare for 2018 growth. We expect total consolidated revenues to increase between 1% and 3%. And you'll see by the details of each business unit later in today's presentations some of the background to those growth projections. Our earnings will significantly improve to between $530 and $630 million, representing a profit growth from the midpoint of 50% or more. Many of the initiatives to grow our profits have already been put into place, and you've seen that, including announcements we made earlier this year in restructuring. For the second consecutive year, free cash flow will improve in 2017 by $400 million. We're going to reach, we'll spend $750 to $1 billion in cash flow in 2017, even as we maintain capitalized investments at a stable level versus 16. So basically, it's coming from operating cash flow improvements. Another way to look at 2017 cash flows, and I think this is important, is that there's essentially 3 strategic capital allocations that we're making in the year. 1 to new products, revenue ramp-up, and cost reduction. So if I summarize that for you, we'll spend $300 million in restructuring in 2017. That's $150 million more than we did in 16, but a $300 million cash outflow in the year. We're completing the peak investment cycle in aerospace with the Global 7000, and we'll spend about $1.4 billion in CapEx. And to put that in perspective, that's about $400 million above our targeted long-term capital investment rate of about $1 billion from 19 and forward. So in a sense, a bit of a non-recurring CapEx. And finally, we'll spend about $400 million to continue to ramp up the C-Series, and that's in line with our plan to break even by 2020 and within the $2 billion envelope that we talked to cash break even. Consistent with restructuring expenses in 2016, we expect special charges in the range of $250 to $300 million, and the cash impact of those charges is already reflected in the free cash flow guidance that I've provided. I'll take some time now to go over the 2017 plan guidance and as well as a roadmap to 2018 and 2020 performance. Let's start with revenues. So in 2016, we'll remain disciplined in matching production with demand, as we did in 2015. We continue to navigate current markets by protecting brand value, by managing working capital, and by retaining strong market share in each of our segments. In 2017, we'll resume growth now that we've set in place strong recovery plans for key projects, as well as normalized working capital management practices at BT. Business aircraft will absorb the revenue impacts of adjusting our Learjet production to approximately 10 aircraft in 2017, and that's down about a dozen units from 2016. Business aircraft year-over-year revenue reductions also reflect the better-than-expected deliveries in 2016, which will now be over 150 units. Commercial aircraft growth reflects the C-Series ramp-up to about 30 to 35 units, and that's offset by a trim of Q400 and CRJ deliveries. We expect in total at commercial aircraft between 80 and 85 aircraft deliveries. In Aerostructures and Engineering, we'll have growth supported by C-Series and the ramp up of the C-Series to the 30-35 units, as well as the pre-production for 2018, and the early unit ramp up for the Global 7000 in the back end of the year. As we go into 2018, we see revenues of between $18 and $20 billion as we continue to ramp up C-Series. Our 2020 revenue targets of $25 billion is supported by strong backlogs, by new product introduction, and a large installed base that produces strong aftermarket revenues. And on the next chart, I'll show you some of the details about how we get to $25 billion. Bombardier is a growth story. Over the next 4 years, our revenues will grow significantly. We'll add $9 billion to our top line and reach $25 billion by 2020. Both the C-Series and the Global 7000 will have achieved normal production rates in that year. Our growth story doesn't rely on any significant rebounds in either markets or macroeconomic conditions. Rather, we're leveraging the strong product investments we've made and the deep installed base that we have in service. You'll see from this chart that we're building from a reset year in 2016. That's a revenue low point in our cycle. And if you look from left to right, you'll see where it's coming from. $3 billion coming from C-Series volumes at between 90 and 120 aircraft, as per plan. We'll add $3 billion for the Global 7000 with deliveries of over 40 units in 2020. Our transportation franchise continues to grow mid-single digits. From $8 billion to $10 billion, it'll add $2 billion to the top line. And we're leveraging a strong backlog, consistent book-to-bill of over 1, and the best product offering in the industry. And finally, with over 7,000 aircraft in service and 100,000 train cars in operation, we expect to grow aftermarket revenues from about $3 billion this year to $4 billion in 2020, adding $1 billion in aftermarket revenues. We'll talk a little bit about earnings now. If you see here, there's a roadmap from 16 to 17 and then to 20. Our earnings roadmap shows how the transformation is impacting our margins and expanding them in 17 and 18. Then that's before we combine it with strong top-line growth that creates really powerful operating leverage on earnings. In 2017, the largest contribution to earnings growth will come from our restructuring actions and transformation. And we'll be adding about $150 million of margin from our transformation programs, including those restructuring activities. Volume and some favorable mix will add a little bit of a positive to conversion. And we're also starting to see some of the benefits of FX coming through our P&L as we start to roll off past hedges and as we turn over inventories that embed those positive FX rates. Now, if we take a step back and we exclude the $400 million loss from the normal ramp-up of the C-Series, you can conclude that EBIT in 2017 will approach $1 billion, net of the C-Series ramp-up costs. That's almost 6% margins across the business, already at this point of the transformation, which is early in our 5-year plan. If you look forward to 2017, from a midpoint of about $580 million, we can see a plan and draw a path to the 2020 EBIT of $1.75+ billion. And the way we're going to get to the 175 or more is from, one, converting revenue from growth. So we'll see that revenue convert to profitability at current margins. So that's in the neighborhood of 2017 margins across the business units. We'll do that by achieving our break-even on the C-Series. And I've talked about the C-Series. You'll see guidance for commercial aircraft, roughly $400 million. So as that moves through, we'll also generate the benefits of moving out through the normal learning curve. And finally, we'll expand margins to 7 to 8%. And as we expand those margins through transformation and restructuring, we'll see more earnings and earnings growth towards that $2 billion target. Jim will take you through the details of our transformation. I think what's important to know is that we've already put in place the actions that are going to drive a lower cost structure. I'm going to switch gears and give you a little bit of detail on our aerospace programs. I think this is a question that I receive often from you. So there's a little bit of background here on how they impact our cash flows in 2017. So first, we continue to hit all of our milestones. And as such, we're on plan to achieve our target long-term investment of about $1 billion in 2019 and onward. In 2017, C-Series cash usage will drop from just over $1 billion, as I talked about on the Q3 call, and as we guided in the full year at the beginning of the year, to about $400 million in 2017. So this represents about $650 million of improved free cash flows. And remember, our objective of $2 billion in the C-Series to break even in 2020. So what that means is that at the end of 2017, we'll be a long way through that journey. About $1.5 billion spent at the end of this year, 17, with the remainder to go as we break even in 2020. About $500 million left. The Global 7000 development program will consume about $350 million in more cash in 2017 than we did in 2016 as we execute the flight test program, and we'll be adding flight test vehicles to the program as well. Later in the year, in 2017, we'll also start to build up the working capital required for 2018 entry into service. So that'll have some working capital impacts as well. Overall, we expect CapEx levels to remain neutral in 2017 with 2016 at about $1.4 billion of CapEx. Working capital will show a net improvement from these programs of about $300 million on a year-over-year basis, generating positive cash flow impacts. So if we look at 17 and 18 cash flow in more detail, I can show you how we get to our 2017 target, as well as the roadmap to our free cash flow break even in 2018. In 2017, we take another important step. We'll have a reduction of about $400 million of consumption of cash. Again, for a second consecutive year, material improvement, almost an aggregate about $1 billion over those 2 years of cash flow usage reduction. The first thing you'll see on this chart is that the $300 million I talked about on the 2 programs is a benefit from 2016 levels, so down about $300 million the way I described it a minute ago on that prior chart. You also notice that we're self-funding the restructuring initiatives that we're taking on. And we're doing this through working capital efficiencies, and those are working capital efficiencies coming outside of the programs fundamentally from transportation, the way we have in 2016, but also from the legacy aerospace businesses. And Jim will talk more about that working capital efficiency plan. So neutral between restructuring and working capital efficiencies in terms of cash flow. And then finally, we'll convert earnings to profit. So we have a step up in earnings in 2017, and that will largely convert to cash flows. And that takes us to $750 to $1 billion of usage. We have a clear plan to achieve our target. And I mentioned it before, but I'll mention it again. The $750 to $1 billion is operating strength and capital allocation towards, one, continue to ramp up our volumes on C-Series, which will eventually bring profitable growth. Two, is continue to invest in a state-of-the-art Global 7000. And three, we're going to fund our cost reduction programs. So what's even more important here is that there's a roadmap, a clear roadmap for 2018 free cash flow break-even, and it's firmly in place, and I show it to you here. Investment in CapEx will continue to come down as we navigate through the Global 7000. And in 2018, we expect that to produce another couple of $100 million of positive free cash flow impacts versus the 17 levels. So down from 17 to 18, about $200 million is our expectation. Restructuring initiatives will be largely behind us. We'll still have some restructuring spend in 18, but we expect about $150 million improvement year over year from 17 to 18. So that draws another reduction in cash flow usage. And finally, C-Series cash flow usage will continue to come down as we gravitate towards a break-even in 1920, and that will produce additional cash flow reduction towards our break-even in 18. So those three components were the fundamental components. Add to that earnings conversion again, and in 2018 we've set out targets of 5 to 6% margins, which are another step up from 17 earnings, and those earnings again will convert to cash flows. So that's the roadmap to the break-even on 2018 cash. Now, to be clear, our objectives are to be beyond break-even, and that's what we're going to be doing towards our 2020 goals. We want to have strong profitability that converts, strong profits that are converted to cash flows so we can create value. This is a roadmap we're putting up here for our 2020 objective. You can see there that we want to be able to achieve up to $1 billion of positive cash flow as we get to the back end of our 5-year plan. We'll do it by generating about $300 to $400 million of free cash flow by exiting the aerospace peak investment cycle and with the C-Series breaking even in 2020. So cash consumption and margins will hit that break-even point. We'll also deliver $500 to $600 million of cash from profit growth, and that's leveraging our top-line growth. So we talked about how we get to $25 billion, but also converting our lower cost structure into profit and then eventually into cash flows. By 2020, we could be producing up to $1 billion of free cash, sustainable flows. With that kind of long-term cash generation, we'd be in a position to deleverage our balance sheet, and we'd continue to drive and deliver strong shareholder value. I'd like to take a minute here, and I think it's the right spot to do it, to talk a little bit about liquidity, something that I think we've made tremendous progress in 2016. We created the air cover to execute our turnaround plan in 2016. We put in place deep liquidity by raising cash, and you're all aware of the transaction we've completed in 16, about $2.5 billion of cash raised. We've also refinanced our 2018 maturities, so we have no maturities until 2019, and those are all very manageable within our cash flows. And we've extended our credit facilities and our revolvers into 2019. So simply said, we expect all the liquidity necessary to turn the business around to complete our execution plan. We'll finish this year with $3.5 billion of cash on hand and total liquidity of $4.5 billion. And as I said, no maturities until 2019. So with this, we have all of the measures needed to turn around the business, to complete our investments, and most importantly, to ensure that we have no distractions on execution over the next 3 to 4 years. So having taken you through the overall business, I'd like to just spend a couple of minutes and talk a little bit about the business units, but I'll leave most of the detail to the leadership team that's coming up behind me. 2017 performance at each business unit underlines the progress we're making in transforming the business and towards our 2018 and 2020 goals. Each segment will deliver strong margins while maintaining disciplined approach to production and working capital, and that's good for cash flow. And without going into the details, you'll see that we'll have mid-single-digit growth across BT, BCA, and Aerostructures from a sales point of view. And margins are expected to be across the board 7.5% or more. BCA will benefit from learning curve efficiencies and will produce 4 to 5 times the volume that they did in 2016, and they'll do so with overall absolute lower net negative margins. So that's showing you the power of our learning curve already kicking in 2017. Maybe if I turn to the conclusion before I turn it over to Jim and talk a little bit about transformation. I think what comes out of this very clearly, and we say this with a lot of confidence, we're in full transformation. We've already seen the benefits of our actions in 2016. We are a growth business. Our investments in a broad product portfolio and our powerful in-service fleet across trains and planes drives our top line in the back end of this 5-year plan as we go to 18, 19, and 20. When you combine that lower cost structure and that top line growth, we see powerful earnings acceleration ahead. We have a clear roadmap to sustainable cash flow generation that will create value for both equity and bondholder investors. So with that, I will turn it over to Jim.